You set your stop loss to protect your money. Then something strange happens. The price drops directly toward your stop. You get stopped out. And almost immediately, the market reverses and shoots back up. You stare at the chart thinking, there's no way that was random. So was your stop actually being hunted? Or is there something happening in the market that looks like manipulation but has a very different explanation? The answer is more complicated and much more interesting. The stop loss trap. Imagine you buy a stock at $100. You don't want to lose more than $5, so you place your stop at $95. The stock rises to $105. Everything looks great. Then suddenly, $103, $101, $98, $96, $95. Your stop triggers. You're out. And then something almost unbelievable happens. The price rebounds. $97, $100, $105, $110. You didn't just lose money, you missed the recovery. This is where traders often say, they hunted my stop. But here's the first thing you need to understand. A stop loss order is not invisible magic, and big institutions don't necessarily know the exact price of your individual stop. What they can understand is something far more important, where large groups of traders are likely to place their stops. Why stops cluster? Think about where an average trader puts a stop. Below a recent low, below support, under a round number, below yesterday's low, under a familiar technical level. Now imagine thousands of traders looking at the same chart. They're not necessarily communicating with each other, but they can independently reach similar conclusions. If the obvious support level is $95, a large number of traders may place sell stops somewhere around $94.50, $94.80, or $95. That creates something traders call a liquidity pool. And this is where the story gets interesting, because large orders need liquidity. Why big players care about liquidity? Imagine a large institution wants to buy millions of dollars worth of a stock. It can't simply click buy once and expect everything to happen at the same price. A huge market order can push the price higher while the institution is still buying. That makes its own entry more expensive. So large traders care about finding enough opposing orders. And a cluster of stop orders can create exactly that kind of activity. Remember what happens when a standard stop order is triggered. It becomes a market order. So if many traders have sell stops below the same price and the market reaches that level, those stops can suddenly become market selling pressure. Now imagine a large participant wants to buy. There may suddenly be a lot more selling available. That can help transactions occur. This doesn't automatically mean someone deliberately pushed the price down just to trigger your stop. That's the critical distinction. The stop hunt may be real, but not how you think. Here's where trading mythology gets mixed with real market mechanics. People imagine a giant institution looking at a screen saying, John has his stop at $94.72. Sarah's stop is $94.80. Let's take them out. That's generally not how the market works. But institutions and professional traders can observe market behavior and understand where liquidity is likely to exist. They know traders tend to react to obvious technical levels. They know certain price levels attract orders. And they know that when those levels break, other traders may be forced to act. So the more accurate description isn't, they know your stop. It's, they may understand where many traders are likely to have stops. That is a very different claim. Here's why your stop gets hit. So often, there's another uncomfortable possibility. Maybe your stop isn't being hunted. Maybe you're putting it exactly where everyone else puts theirs. Suppose you buy a stock after seeing a support level at $100. You decide your stop should go at $99. Why $99? Because that's where you feel comfortable. But thousands of other traders see the same support. They place their stops around $99. Now the market reaches $99. A wave of selling begins. The price falls to $98.70, then $98.40, and suddenly the selling disappears. Buyers step in. The market rebounds. To you, it looks like someone deliberately hunted your stop. But there may be a simpler explanation. The market found liquidity below an obvious level. The SEC confirms one important part. There's an important mechanical detail traders often overlook. A standard stop order becomes a market order once the stop price is reached. That means the stop price is not necessarily the final execution price. In fast-moving markets, the execution price can be significantly different. This matters enormously during volatility. Imagine your stop is $95. News hits. The stock suddenly drops from $96 to $93. Your stop may trigger, but you might not sell at exactly $95. You could receive a worse price. That's called slippage, and it can make a normal stop loss look like something much more sinister. Stop limit orders change the equation. Now consider a stop limit order. Unlike a standard stop order, a stop limit order becomes a limit order when triggered. That gives you more control over the price you're willing to accept. concept. But there is a trade-off. You may not get filled at all. If the market moves rapidly through your limit price, your order can remain unexecuted. So there is no magical order type that eliminates risk. You are always choosing between different risks: execution risk, price risk, and market risk. The most dangerous stop is the emotional stop, but there's an even bigger problem. Many traders don't place stops based on market structure. They place them based on how much money they're emotionally willing to lose. For example, I'll risk exactly $100. So they choose a stop distance that makes the dollar loss equal $100. But the market doesn't care about your $100 limit. If normal price fluctuations regularly move $2 against you, a stop placed inside that normal movement may be triggered repeatedly. This creates a brutal cycle. Enter, get stopped, re-enter, get stopped again. And eventually you conclude, the market is hunting me. Maybe. But another possibility is that your stop is simply too close to normal volatility. Big players don't need to manipulate every move. This is perhaps the most important point. Markets are enormous. Prices move because of millions of decisions. Institutions, hedge funds, market makers, algorithms, retail traders, news, economic data, options positioning, liquidity, fear, greed. Sometimes a price reaches a well-known level because many participants are watching it. Then stops trigger. That creates additional orders. The price moves further. More traders react. More orders appear, and the move accelerates. From the outside, it can look like someone deliberately designed the entire move. But complex markets can produce surprisingly coordinated-looking behavior without a single mastermind controlling everything. So what should you actually do? The answer isn't never use a stop loss. Stops are legitimate risk management tools. The better question is, where would my trading idea actually be invalidated? If you're buying because a support level should hold, placing your stop directly on that obvious level may expose you to ordinary volatility. If you're trading a breakout, placing your stop exactly at the breakout price may leave you vulnerable to a routine retest. The goal isn't to find a magical stop nobody can touch. There is no such thing. The goal is to define the point where your original trade thesis is genuinely wrong, and then size the position so that reaching that point doesn't destroy your account. So, are big players hunting your stop losses? Sometimes large market participants may seek or react to liquidity around predictable levels. But there is no evidence that every retail trader's individual stop is being specifically targeted. What we can say with confidence is this: stop orders can cluster. When triggered, standard stops become market orders. Large amounts of forced buying or selling can create sudden price movement. Fast markets can produce slippage, and obvious technical levels can become magnets for orders. That combination can create the exact chart pattern that makes traders believe they took my stop and then reverse the market. Sometimes that may reflect deliberate trading around liquidity. Sometimes it is simply how markets behave when many participants react to the same level. And perhaps the most important lesson is this: don't try to hide your stop from the market. Instead, understand why you're placing it there. Because the goal of a stop loss isn't to predict where the market will turn. It's to tell you, my trade idea is wrong. Get out. And if you can master that distinction, you stop blaming every losing trade on a mysterious stop hunt and start understanding the market itself. If this video changed the way you hit like, subscribe, and share it with a trader who says they always hunt my stop. And tell us in the comments, have you ever been stopped out only to watch the market reverse immediately afterward? Was it a genuine liquidity move or simply bad stop placement? You decide.